Awesome. So looks like we're live here with a good friend of mine. So I'm here with Troy Rosales. He is a friend. He's at Connexa Capital, who I've also been familiar with Connexa through Jonathan. Connexa went through our fund accelerator years ago, and just connected with Troy recently. He's also in New York, just like me. So excited to have him on the pod. Just to give a quick overview, and then we'll have Troy just go deeper on his journey into private equity banking and venture. But Troy is at Connexa, Connexa Capital, primarily focused on sourcing and evaluating investment opportunities, as well as providing operational support to the portfolio companies. Right. So there's essentially the execution side where you're kind of doing the deals, taking them to IC, but then a lot of things that people don't see behind the scenes is the portfolio support. So that's going to be an exciting topic to talk about and unravel. But on top of that, before joining Connexa, Troy was a private equity associate at Platinum Equity. Prior to Platinum Equity, Troy worked in investment banking at Houlihan Lokey in the business services group, and at Presidio Technology Partners covering automotive SaaS verticals. Troy graduated from Cornell University with a Bachelor of Science in Applied Economics and Management. So super exciting background and just a lot of really hot topics to talk about. It being September in the venture ecosystem, there's a lot of insights that we're seeing. So excited to kind of go through all of those things. But before we go through all of that, Troy, hopefully I did a good job with just a high level overview on your background. Maybe you can start with just your initial origin story. Like, tell me, about your early career. Maybe think about what you wanted to do when you were in high school and how that evolved when you were in college, and maybe some of your influences. Maybe it's your family, maybe it's big brothers, big sisters, mentors. But walk me through kind of your journey in the beginning and how you got to where you are now. And then I may interject with some questions and comments and reactions.
Of course. Thanks for having me, Joel. Happy to get started in terms of the origin story here. So I come from a pretty untraditional background, despite all the merits and school credentials. But when I was in high school, a lot of my family came from just traditional blue collar work. It was my dad who graduated from UC Berkeley as a transfer student when he was 30 years old. And we moved to Bay Area from LA when I was 8. And my dad got introduced to some of the high finance work, so investment banking, consulting, private equity. This was all novel to him and new to me as well. And when I was in high school trying to decide and deduce what I want to do career-wise, you go to career fairs, you hear about software engineering. That wasn't something that was aligned to me, but vapidly, I always want to earn as much as I could, right? And my dad was whispering me, saying, "Hey, there's these guys called investment bankers that make a lot of money. They work a lot of hours, but could be something that you might be interested in." I was like, "Okay, that sounds good." In high school, while my GPA was pretty strong, I knew that if you want to go to a strong investment bank, there are these target schools. So pick your flavor of Ivy League or Stanford, UC Berkeley, right? And I decided that if I really want to do investment banking, I'm going to have to try to go to the best schools to better my odds. So I only applied to schools that have like a sub 10% acceptance rate, and I got accepted to none. So I'm graduating senior year of high school, no college lined up, right? And I'm thinking in my head, like, there's only one other, chamber in the bullet that I can do to get into these schools, is that I go get my associate's degree at community college and then hopefully lateral and transfer into a better academic institution. So that's essentially what I did. So I graduated 2016 from high school with the goal of transferring to a top university to be able to be more eligible for these entry-level roles, right? It seems like a premeditated move, but it essentially was. I was I was very motivated to get a good job and knew that if I went to any sort of in California CSU school, those opportunities are afforded to you, but they're a lot more difficult versus the opportunities that were afforded to me when I ultimately transferred to Cornell. So I did my 2 years in community college, did very well. frankly, it was pretty easy, I would say, as long as you're motivated. And I had 2 jobs. I worked at CVS, I worked at a laundromat, and also as a lifeguard instructor. So kind of had the extracurricular stats, was student vice president of finance, just kind of all the pedigrees that you need to make yourself a transferable candidate. So once it came time to transfer, I was thinking in my head, okay, what is like the easiest, best school to get into from a junior transfer perspective? I typed that on Google, and Cornell University was the first one that came up. I was like, all right, shoot, why not? Just give it a shot, right? And I got in. I was like, wow, this is awesome. Never did, had no idea where it's at. I thought it was in New York City. Had no idea where this place is, called upstate New York. So 2 years after I graduated high school, I was at Cornell as a junior, knew no one there, still had a, itch in my brain of like, why am I doing this? I'm here to ultimately get a job. And while, I wasn't fortunate to have like the same 4-year university experience of like being in freshman dorms and sophomore and making friends, for me, it was all work oriented and all catered to like getting a job. And that was the reason why I was there. And it was a little difficult coming in fresh as a junior, right? You have no GPA. You essentially have this no name random community college GPA that doesn't account for any job applications. And so it was a little difficult at first. So I was kind of really just putting my head to the grindstone, looking for internship work, and was fortunate to land one with Barclays in their operations role. It's not something that was going to convert to full time, but it was a good name to pat on the resume. And come 2020, when I'm trying to graduate, of course, COVID-19 happens, and that puts the whole world on hiring freezes.
Sure.
I got in cahoots with my first employer, Presidio Technology Partners. Let me know if you can still see me. I think
I can.
Okay, awesome.
Yeah.
Presidio Technology Partners, shout out to them. Katie and Bill, they're a solid team and are really strong in the automotive software space. I just sent a resume over to them, and they wanted to get me started shortly after graduating. And it was on a internship subject to full-time hiring, pending if it went well. So 6 months, I really was grinding there. It was only a 4-person team when I was there. And I believe now they're at 12 or 15 folks. So they're going pretty well and definitely making strides in this space. But when I was there, I was great to finally be in an investment banking role, despite it not being a brand name or in a particular sector that I thought was, worthwhile. Not saying that automotive software wasn't something I wanted to do long-term career-wise, but when you're a younger lad, it's nice to have exposure to a wide array of different types of industries. And during 2020, 2021 is during ZERP, the COVID boom bust hiring of investment banking. And that was when the lateral market was very hot for young investment banking talent. As there was a Goldman Sachs report that came out, or from some investment bankers working there, saying that the hours were too tough, yada, yada, yada. They're like, all right, well, we're just going to overhire. And I was fortunate to join on that hype train of overhiring across all these different banks and decide to join Houlihan Lokey in their business services group in 2021, I believe. So I did year Presidio. I started in Houlihan in 2021, and that was a great experience. My entire class was all laterals that came from other random no-name banks. It was a really great group with strong transaction experience. I worked across a pharmaceuticals deal. I was working on the TNL team, the environmental services team. There's so many different industries that goes into business services. I'm very grateful for that experience there. Of course, the job is a little difficult, but there was really able to hone in and refine more on I'd say enterprise level, the processes with investment banking, whether that was Excel, PowerPoint, and just general networking too. When you're working at a smaller bank, it's a little difficult sometimes to grasp the scale of these large organizations that have research teams and built-in, Power BI tools and PowerPoint for that matter to make your job a lot more easier. And that all comes with scale. After 2 years there, I was reaching the point of where I need to matriculate into my associate role. I was thinking, I think it might be nice to, maybe pivot over to the buy side and get a feel for that. I think investment banking could always be there if I want to get back to it. But
Sure.
I think but in terms of long-term career-wise, private equity does open up doors for you. And what got the tap on the shoulder from Platinum Equity after recruiting for, I'd say, 6 months or so. It was a pretty tough market when I was recruiting in 2023, and was super hyped. Platinum Equity is a great shop, large cap sponsor based in Beverly Hills. I believe they just raised a $13 billion fund. They're doing everything right, and they work on great transactions. Mostly, have a strong skill set for corporate carve-outs and more hairy deals that other sponsors don't want to play in. But that's where a lot of value creation is in. And so I joined a 5-person team, so kind of a pod structure, and I was covering large cap industrials, chemicals, and business services verticals. And it was a little different from what I was doing back at Presidio, different what I was doing at Houlihan. There's a whole different ballpark in terms of the scales of these businesses, the different type of diligence that you have to go through to ultimately acquire, own, and advise on these portfolio companies. And that was a really valuable experience. When I was there, we closed 3 transactions, my deal team. There was Cook and Boardman, which is a steel, metal, hollow doors distributor, mostly in the Northeast, Southeast, Southwest. USLBM, pretty large transaction. They're the second largest building products distributor in the United States, from anything from doors, roofing, siding, trusses. That was a really fun transaction. And then the last one before I sunsetted was Rise Bakery. And they essentially operate as a supplier of bakery products to food service and in-store bakeries. So think Walmart pies and Costco muffins. That was a really fun one. But working on 3 platform transactions and 12 months I was there was a little too much of a burnout for me. When I was there, we went to LOIs on 8 different deals, closed 3 of them. And for those that might not be aware, these are like fully baked bids where you're basically, throwing yourself in the fire every single month for 12 months. And I'm thinking in my head during my last days there, looking at, more of the seniors that are there, my other counterparts, is like, hey, do I really want to do this like for the rest of my life? It doesn't get better if you're a VP, right?
Sure.
I think 4 or 5 years from now, can I really be doing this for 4 or 5 years and lose all my hair and lose friends and relationships? I decided just to cut bait because I'd figured the juice was not worth the squeeze there.
Sure.
And so I quit and decided to move out of LA and get the hell out of Dodge.
Mm-hmm.
And I finally, for once, in 4 or 5 years, was like, hey, I finally have some like free time. What do I want to do? One of those cliche, let's go find ourselves. So I traveled to Hawaii. I went to Arizona. I visited family I never see. I have a full set of great grandparents that I don't hang out with. There's like 5 of them. So I really got to spend time with family, friends, start working out again,
Sure.
and get, try to get back to the road to 2 plates on the bench,
Mm-hmm.
and move back to New York. When I was in New York, I got in cahoots with Jonathan and Taha at Connexa Capital via LinkedIn Easy Apply. Don't listen to the haters. LinkedIn Easy Apply is a way that a lot of people get jobs these days.
Sure. Because the formatting is already, you just have to upload the PDF, right? And then it pushes it through.
You literally have your PDF saved on your LinkedIn profile, and all you have to do is just click on the button, and that's it. Yep. So one shot on the Easy Apply for Connexa. Found strong connection with their team from the get-go. Mm-hmm. I think what really, when I was recruiting, I was looking at a lot of co-investments, secondaries roles, so a little derivatives of the alternative investment space in private equity. Yeah. But at least for venture, I was like, hey, this is a really like fluffy asset class, right? Mm-hmm. Like a lot of the skill sets I have are, made to do, I say, quote unquote, real work, like real diligence with financial modeling, PowerPoint creation. And after having some deep in-depth conversations with the executive partners there, the not management team, well, Jonathan and the other partner we have there, seeing the real work that they do, almost at the same level of private equity rigor with their analyses, it really resonated with me. It's like, hey, there are people within this asset class that are doing real work and have a lot more conviction on deals based off unit economics versus more thematic investing, which isn't inherently bad, but it was a style of investing within early stage that resonated with me. And I appreciate at Presidio that these are, sub 10 million EBITDA businesses that are in the software verticals that are doing something, pretty unique sometimes, even though it's in automotive software. It was really cool to see businesses that are on a growth inflection versus more antiquated chemical co-manufacturing industrial businesses that I was working on at Platinum. So, everyone has their different type of flavor of things they like. I think for me, that resonated with me. And I joined Connexa in January of 2025. So it's been almost 10 months now. And it's been really great. Really finding strides with the team, have gotten to work on a wide array of different deals there, both from, early stage to more growth equity-esque type deals. And really find the dynamics of venture to be a lot more aligned with what I'm doing long-term career-wise versus what I was doing both in investment banking and private equity. So yeah, that's kind of like the long-winded answer of where I was and how I got here.
Sure. No, I mean, that's really helpful. I mean, one thing that I realized is like, when I think back to myself when I was like 15, 16 years old, I feel like I'm still the same exact person. Like my conscience, like everything else is about the same. I just have compounded more knowledge. So maybe I know more. Like I knew nothing about what private equity and venture was, right? And I think like some of the life skills and values that I picked up when I was even in my teens, some of those still carry over, right? So, kind of funny questions for you, like those smaller jobs that you took, you were a lifeguard, right? I forgot the other two jobs that you took. I think you worked at CVS. What are some of the life skills and professional skills that you developed in those roles? Just kind of that may still be part of you or part of your DNA. And I guess the other question is, do you feel like you're still the same person, like your conscience, as you were when you were, in high school and maybe early college?
Yeah. I don't think I'm as much of a knucklehead as I was when I was 15 or 16 per se, but intrinsically, like a lot of like the core values and are you a driven individual or not? Sometimes you have that dog in you and sometimes you don't. If you don't, you can grow it. And that sometimes rubs off from family members or just when your back is against the wall, right? So I agree with you. I think for me, always having a goal, sticking to it is something that I've always lived by. It's kind of a North Star, right? You don't always need to get to the point B, but at least that you're aiming for it, right? Because sometimes you don't know what you don't know. But as long as you're working hard and you stay motivated, I've never seen an individual that's failed trying to pursue their dream goals. But everything just becomes a learning lesson. At my first jobs, there's one that I forgot to add to, and that one was a lot more formative in terms of just thought pattern behavior. Is I was working with this local artist when I was working at the lifeguarding, not the lifeguard instructor, I was a swim instructor at the local pool in Albany, California. This lady, I was working at the front desk, came up to me and she said, "Hey, I need someone to help move boxes at my house." She was an elderly lady. There's an elderly swim class going on. So I see her every day. She's like, "I'll pay someone $20 an hour." And I'm like, "Shoot, I'm only making like 12. I'll leave right now and go help you." And she's like, "Sounds good." And so I walk over to her beautiful house, and she's a very nice painter that works on a lot of abstract art. Her name's Stephanie Weber. You should check it out. And started developing a nice relationship with her. And that parlayed into working with her husband, where he was doing a lot of data analyses work. And so I got to dip my toes a little bit in Excel because I never really worked in Excel at all. He was an older individual as well, so had the patience to realize that I can do like a sum formula, and that was all great and novel to him. But really, what I was taking away from it is that you kind of just take risks and come in with the best mentality and not really, looking to get anything crazy out of it. But if you are in the right spot at the right time, opportunities can be afforded to you, but you have to make yourself available. Second, when I was working with them too, is that just being on time, diligent. It's very cliche in terms of like showing up 5 minutes early, but again, coming in the right headspace, coming in on time, trying to do the best work you can is always something that I found to be best. Like if you're working at CVS, don't be on your phone if you're at the cash register. Don't want to be doing that if you're a lifeguard either, or the cops get called on you.
Sure.
But yeah, I'd say a lot of the ambitions that I had as a young man still am, thank God, at the ripe age of 27, do stick with you for the long term. But it's like a muscle, right? If you start not going to the gym, start waking up late, stop taking care of yourself, like you can become unmotivated, right? And if you are a motivated individual, like that stuff feels like depression to you sometimes, where you're not on the same grind set that you were before. So it's always good to, keep some semblance of habitual behavior with maintaining that type of mindset.
So you said your father was kind of within the circles of, the private equity and venture ecosystem. So um, it's interesting too when you mentioned your transfer strategy. There was somebody that came on, I think a few months ago. They did the same thing. They like went to community college, and then I think they went to like UC Berkeley. But it was more of a hack to save money on tuition, right? But I didn't know there was kind of a little. Is it just as difficult if you're trying to transfer to an Ivy League school versus just kind of the general freshman application, or is there a little bit of like a window of opportunity from just using the transfer method?
Yeah, for the Ivy Leagues, it's such a black hole in terms
Yeah.
of is it easier or not. I will say this: there's definitely a way smaller pool of folks that are trying to transfer to junior, mostly because not that many people know about that.
Yeah. Well, now everybody knows about it. So
yeah, exactly. But a lot of these Ivy League programs, and I was fortunate to get part of it too, is that they are looking from folks from untraditional backgrounds. And untraditional background is also like coming from a community college, right? There's a lot of people that transfer as a sophomore from, Syracuse University or Ithaca College and can usually skate their way by. But for, some of these more like brand name Ivy Leagues, like throw Cornell to the side, but like Columbia, I had a buddy that transferred to Columbia as well from my community colleges. And there was a Brown kid that, like, if you are able to have, at least like a 3.9 or 4.0 GPA, the fun fact about community college is that, a little more goated from the grading perspective is that A minuses are, and at Cornell or at UC Berkeley, those are considered a 3.7, but in community college, that's a 4.0. So as long as you're getting 90% above, you'll have a 4.0 GPA. And no one wants to do extracurriculars there. Like I just signed up to do student body as vice president. And it's just like, I now oversee like a budget of $100K for the school's student body. And folks would come to me to ask if they want to do stuff for the Muslim Student Association or whatever club. And I was like, okay, well, that's literally my job. And I just walked in and signed up for it. So there's so many opportunities afforded to you, but you do have to have a little more grit to be able to find it, because no one is teaching you anything in terms of job preparation, what classes to take is very DIY. It's like building your at-home computer, right? You can buy one from the store and spend like $3,000 on the GPU and everything. But if you want to take the time and learn and go on YouTube to learn how to build a computer and get all the components right, you can make the same specs for half the cost. I kind of find that kind of similarity. It's a little more, I give some to get some a bit. But everyone that's there for the most part is either a lot older, they're doing it just to do a transfer acceptance guarantee to a local state school. Not that many kids are at that school at the age of 18 to 20 looking to transfer to an Ivy League institution or work investment banking or consulting. It's just not a thing. If you start as a freshman year at NYU, you're inundated with knowing what the hell BCG is and Goldman Sachs. You pluck any kid from my community college, they're not going to know anything about investment banking or consulting or what, target school even means. It's just a very unknown thing to them because it's not taught, for better or worse. But if that's the kind of environment you want to be in, you're going to have to work to get there.
No, I totally agree. And I think proximity makes a huge difference. And who you surround yourself with. I mean, I knew nothing about venture when I was early in my career. I mean, when I was a child, I had an uncle that was a successful engineer, and his company got acquired, and I just figured, hey, maybe I'll be an engineer too, and
Yeah, right.
most of the people in my ethnic community were either told to be a doctor or a lawyer or an engineer, right? So but what's funny is, like, God forbid, don't be a plumber or don't, do HVAC. And now people that are doing plumbing and HVAC are, multimillionaires, right? So it's interesting how, actual trade businesses that are essentially essential are super lucrative and obviously, now in high demand. There's more demand than there is supply. So that's kind of something that I've been seeing that's pretty interesting. But one thing that I'm also interested in is, what were some of your first observations, and how did your perspective change when you just set foot at Cornell and you started kind of, seeing the energy, what other students were talking about? What were some of the first things that kind of made you open your eyes a little bit in terms of, like, high finance and asset management?
Yeah. Definitely from like a cultural perspective, first day is that, at least in the business program that I was in, is that everything was oriented to getting a job. From the school being able to market that on their website, saying, hey, we have 99% placement out post graduation. That kind of culture was rampant throughout the undergraduates. Gossip between a lot of like the job nerds is like, hey, where's Troy working full time? Or like, hey, where's Joel getting a summer internship? Like that kind of stuff is hot gossip and really gets you going in terms of like being someone that has a lot of respect because you got the summer internship at Lazard.
And it stimulates a little bit of a competitive spirit.
Correct.
As well, right?
Yes, it's a little bit of a dog eat dog world in terms of like, we both know that like we submitted at the job fair, a role for like EY's transaction services, right? But only one of us gets it. I'm gonna be a little sour about that, right? But it's just a job at the end of the day, or a summer internship. Sure. But that kind of culture was a little bit of a culture shock to me. And it was funny to see the difference in terms of care about, academics to the same level that you do at community college, because a community college, right, it's the last shot, right? You have to get good grades because you can't start from scratch again. You can't start back in high school and get a better GPA to restart. Like, this is the last dance, so to speak, right? But once you're in the club, right, whether it's Cornell, UC Berkeley, whatever school, Texas A&M, like, you don't got to worry about that anymore, right? You just got to get by, get your 3.7 and call it a day and get a job. So it was interesting to see how more easy the academics were as well, relative to just the sole focus on jobs. But that was something that I was ultimately doing it for. So I thought it was great. It was just a little more funny hanging out with all my Berkeley State College kids that, didn't give a flying F about it, to all these kids. That's all they want to talk about is, where are folks working? How can I join the investment banking club? And it was hard joining as a junior to these clubs because there is some, I don't want to call it ageism, but classism in terms of like, juniors don't typically join these clubs. You join as a freshman. So I was rejected from pretty much like every single club that I wanted to do that was business oriented, whether it's the investment banking club, consulting club, venture club, which seems odd, but it's kind of just a thing there because it is good resume patterns and they have like a little network. And again, it's difficult to transfer as a junior, but I would say that was also something that I thought was a little odd, but you got to respect the game sometimes.
Yeah, no, that's helpful. And walk me through the interview process. Let's start with banking, then private equity, and then venture. And I love two frames, like, your perspective as the interviewer. And, obviously now I can imagine you've been involved in several of the recruiting processes to hire talent. So like so I'd love to hear both perspectives, and maybe we start with banking and then kind of think about private equity. Obviously, much more technical skills that are required for banking, and then even PE, and then much more analytical, instinctual, people-driven decision making. You could probably do some return analysis on the venture side, but would love to kind of have you unpack it because you've got your own perspectives.
Yeah, certainly. So starting with banking, from my experience, at least for like a summer analyst program, or I'll just do full time. But for full time, when I was joining Presidio, it was a lot more conversational, behavioral in nature than anything else. No case study. When I was lateraling to Houlihan, there was a model test, so you had to do a 2-hour DCF or LBO analyses. I think I got to pick either or. I think I chose the LBO. But that's pretty standard for most of these interviews. Also, for any lateraling, it's literally a 1 to 2 week process. If they are opening up for laterals, that means the group is sweaty and they need bodies quickly. And whoever can do the process in 2 weeks, and you're not weird, the job is frankly yours. So a lot of other kids that at least for investment banking, it's very straightforward, where there are sometimes, general technicals that they can ask you in terms of, verbally, of like, hey, walk me through the drivers of an LBO, or walk me through, what is WAC, right? I've never really gotten those, fortunately, in my interview processes. They've always been deal oriented work because I was a lateral. Because ultimately, if you work any investment banking job, for the most part, you're not really doing that many LBOs or DCFs. Like sometimes you are, but it's really only for pitch materials. If you're in a good group, like you are doing deals, and doing deals is basically just being a sell side analyst, making SIMs, management presentations, operating models, and acting as an intermediary between management and the buy side teams that are looking to acquire the business that you were advising. That's kind of like high level. So again, a lot of my interviews were all catered towards actual deal experience than talking about more theoretical types of analyses that, a lot of folks are kind of sold in the M&I 400 guides of like, hey, you need to walk through sum of parts analyses. It's very far in between. You could get asked it, and you do have to be covered for all these things, but I was fortunate where I didn't have to. On the flip side, when I was interviewing kids for investment banking, it was the same. I just gave what I got. So essentially it was only interviewing and asking about related deal work, if they did a summer analyst role or if they did a full-time job, asking them what their role in the deal was, their thoughts on the transaction, would they invest in it in themselves. In investment banking and private equity, when you're recruiting, typically you're coming from either investment banking or consulting roles, and you do have transaction experience. And so you do have to be pretty well versed on the roles in terms of what you did, why they were looking to sell, who was the ultimate acquirer, if it was a closed deal, and what was their rationale, right? Are you working on an education technology deal in a space where there's insulation from AI, or is there like a large growth tailwinds for this particular end market? Just having a strong sense of like putting yourself in the buyer's shoes to be able just to talk at the deal at a very high level. So that was something that I did when I was recruiting too, even for private equity and investment banking, kind of having a cheat sheet of like, what's the company, what are their like general high level financial metrics, deal rationale, key risks, and deal merits for the deal. And I would ask the same questions to folks as well. And also just try to get a sense if I'm working, call it on average 70 plus hours a week with some of these knuckleheads. Like I want to know who they are and make sure that there's strong chemistry as well. Because it's a very, it can become a very toxic culture if you join the wrong team and they don't like you, because you can only know someone so much over Zoom versus going to meet them in person and get to know them.
Let's talk about that. So I'd love to know how you can see if the vibe works out. One thing that I heard recently that was really interesting was if you're about to hire somebody or go into business with them, just get coffee with them and see how they order. Yeah. And if they just can't decide what they want and they go back and forth, That just shows maybe their decision making, like just basic decision making skills versus like, look, you go in, you want a coffee with skim milk, right? And if you're starting to argue with the barista, or you're indecisive, that may be something to think about. And then just kind of how you interact with service staff at a restaurant, right? So how are you treating the waiter? Those are just cues that you can't really pick up on a Zoom call, right? But we'll love to hear any other. And then obviously you could just take someone out drinking,
Yeah.
see how much they open up. But any other just cues that have worked for you in terms of like that test, right? They call I guess they call it the airport test, right? Is this someone that you'd want to be stuck in an airport with and be okay with if you're stuck with them, for 3 hours, right?
Yeah, 100%. One fund that did that well when I was interviewing with them was AEA's small cap team, I believe. They would host these little like blue bottle coffee chats where you just chit chat with an associate that's on their PE team for 15, 30 minutes. Mm-hmm. And it's not an interview. They're not asking about deal work. You're literally just spitballing with them, right? Mm-hmm.
And it's not in the office, so it's kind of a different environment, so.
Yeah, because truth of the matter is, like, being able to do LBOs and investment banking work is very commoditized, right? At the end of the day, like, you can be very good at all the LBO Excel work and PowerPoint stuff, but you have to be a pretty chill person for people to like you, right?
Yeah.
Sometimes you can work at a bot shop where they're all bots and you're a bot, and that works perfectly. But if you want to work at a firm that has strong culture, you're going to have to add on to it to some degree.
Sure.
So yeah, a lot of like the work, like there's so many kids in investment banking that are trying to go to private equity, and they can all do the job, right? It's just having strong chemistry with the team. I think it's important. When I did the reverse when I was joining Connexa as well, given it's only 3 folks, including myself. It's like, hey, all right, I'm going to be stuck with this other, investor associate. I need to make sure that I do my own due diligence if I can like have dinner with them and have a good time. Fortunately, my coworker is great and I have nothing negative to say, but we had a great dinner. I was like, hey, like, this is really nice. Like, it's outside of like the work environment, the knives are down, guns are down. Like, we're kind of just like having a good time, just chatting like buddies. And that's important to me because you can talk about work with someone all day, right? But it's better when you get along more, right? You have a good boss that likes you, you like him, you have a nice coworker, you like him, yada yada. I can also talk about the PE recruitment process as well, if helpful, but I definitely agree that the airport, litmus test is definitely worthwhile once you reach the end stages, and it goes both ways as well.
And I think if you really enjoy what you're doing, right? I mean, that the enjoyment of working with the people it's almost probably, I would say 60% of your life, right? Even if you have a family and you have kids, 60% of your life is your work life, so if you're really unhappy there, it's mostly because of the people, I would say, that then it really feels like work. But if you really enjoy what you do, you really love the people that you work with, and then there's no problem talking about work all the time, and checking your email every once in a while, even if it's off hours, because you really enjoy what you're doing and it doesn't feel like work, right? Like, I think Jensen Huang said this. He's like, look, when I wake up, I do work, and I work till I go to bed, and when I'm not working, I'm thinking about work, and it's really what I enjoy doing. It's part of you. So I think if it's really kind of your passion and kind of your zone of genius, I don't think it really is work. There is work in general, right? There's execution that needs to happen, but as long as you enjoy it, hopefully you're having fun while you're doing that.
Yeah, I agree. Especially when there's significant wealth creation tied up in your work as well, right? Like, think about like investment banking MD. It's kind of, you eat what you kill, right? So, are you gonna earn $100 million in fees and collect 20% off of that, or are you not gonna make anything this year? That's what keeps going a little bit, right?
Yeah.
Or if you're NVIDIA CEO, obviously significant wealth creation tied up in his RSU. So, better make sure that the earnings report come out nicely. Same thing with private equity seniors, right? you have carrying the funds. And if you know that this deal is going to be a moon rocket, this is great. And you want to just keep going for that next high, right? Make sure you minimize the zeros. As a junior, it's a little more difficult to, find yourself in that position, right? Where you have, call it skin in the game or ownership, because you might not have that same economic incentive. Sure, you might collect like the 300, 400, associate total comp, right? But that's not like the beta MBA salaries that these guys are getting that are, maybe four layer, 4 notches higher than you in terms of the totem pole. So it's a little different sometimes, but I definitely agree with you. But yeah, so for private equity, it's all pretty canned, I would say, and templated. Whether it's middle market, lower middle market, large cap. If you're not doing, I've never done on cycle recruiting. I always thought it was a little too hectic, and didn't really care to do that. But I always did off cycle, and I felt like there were a lot more diamonds in the rough in terms of the firms that were doing things. And I would say it's usually, call it like a month and a half process where the first call is like either with a VP or principal, and you just walk through deal experience, right? You might get over the next interview like a paper LBO. Sometimes they do live case studies over Zoom where it's almost consulting in nature, where you're giving recommendations and kind of double clicking into analyses. But always you will be given either a 2-hour or a 48-hour or a day LBO case study, right? Where you're given either a blank Excel, a pre-templated Excel sheet, or a sim, and you're asked to make an LBO based off of certain transaction assumptions. And send it back within the desired time frame. From there, then you have to present it typically to walk through your assumptions. If you pass, right? If you have a busted LBO model that like was left out, or your balance sheet's not balancing, usually you'll get axed at that point. But given all the resources at people's disposal now, like it's pretty cut and dry whether you can do it or not. Very, of course, expected at this point. You don't have to be a LBO master when you join as an associate private equity firm, but just having the baseline understanding of how things work is helpful.
And when I learned, I always just started with some base template. I mean, we'll love your inputs and just kind of how people can pick it up. But I always kind of learn by just starting with a template and like really understanding how that model worked. I would debug it almost, right? I would click on like the cell and like understand that formula. And then the best way for me to learn was to actually like add something to it, like add like an additional piece of sensitivity analysis, or like add some additional projection, or even like a graph. And then over time, like I was always intimidated by it when I started, but then once I built more confidence, I started to like really nerd out on it. I'm like, oh wow, what if I do this projection, and then I add some seasonality to it, right? So so is that something that has helped you, and you've mentored people on, or what do you think is kind of a good way to kind of debug the model and maybe kind of understand its components?
Yes, building from scratch is the best way to understand any financial model, whether it's a simple operating model or LBO or DCF. In my like freelance tutoring time, I walk through building these files from scratch. You just make up assumptions on the fly. When I was getting started, right, when I was in investment banking and just like trying to understand a little bit more, right, in my free time was YouTube. There would be guys that just have a blank Excel sheet on YouTube. They just build out the whole thing, and you can literally pause it and be like, what did they put? Oh, okay. And you unpause it and you start typing away. And you build it alongside the guy on YouTube. I found YouTube to be a very powerful source. Now there's like a plethora of different online programs where you can pay to, of course, like have live instructors go through things. And also just have like pre-templates that you can mess around with too. The world's a great place now. It's a very, I would say, a lot more commoditized now in terms of the tribal knowledge of how to build these things, right? And the resources available. So yeah, that was kind of like how I got a lot better. And just like just pure reps, right?
Yeah.
You do one and like a year can go by and you haven't done it and you won't know how to do, the debt pay down waterfall schedule anymore. So yeah, it's all reps like with anything.
Yeah. Yeah, and it was interesting. I looked at, like 3 titans across all asset classes, right? I mean, everyone looks up to like Steven Schwartzman, right? Steven Schwartzman's like 52 billion in net worth, $1 trillion, in assets. And then we've got like Vinod Khosla, who's I think like worth 11 billion. Forgot what, how much he was managing, but, just PE has, grown to be the biggest opportunity. And, it just goes downstream, right? When you get to middle market PE or when you get to growth equity, and then you're essentially getting into buyout, there's the, just based on what I'm looking at, there's the most massive upside. And then I really enjoyed, there was a podcast with the founder of Thoma Bravo, right? He was one of the earlier people that, I think he started in banking and then he got into software private equity. You think about like Vista Equity Partners as well, right? So what are some of the higher level trends? Because as now that you're in venture, we could talk about venture, but with venture, how do you guys think about partnering with these entities downstream, especially when they're managing massive amounts of capital? They could be a capital partner downstream to support the early stage investments that you made, right? So we'd love to hear some of your reactions to some of those comments, and then that might be just a good segue to talk about venture and breaking into venture.
Yeah, I would say just like my comments on the PE landscape is that it is become a lot more of a mature industry at this point. Definitely during 2020, 2021, you saw so many emerging managers, right, and funds being raised at oogles amount. Some have stayed and some have closed up shop, right?
Yeah.
With the rise of interest rates, the lack of deal flow, and just the relative pricing, and bankruptcies have really crippled a lot of OG sponsors that used to be in the market. Definitely something that I saw when I was in private equity, especially when you move higher up in the layer cake, is that if you're working at like a Platinum or a Thoma Bravo or Vista Equity, where you're working on deals call it above $1 billion enterprise value, is that you're ultimately acquiring a business from another sponsor. It's just a game of hot potato, right? And the hot potato game ends when the company gets too big and you just dump it onto retail investors. Not a bad play, right? But that's kind of like the only plays that you can do sometimes for the deals that I was doing at Platinum. A lot of the value creation comes from the lower middle market and middle market sponsors that do strategic add-on M&A and then expand and sell it to a larger sponsor that can ultimately acquire it. For our underwriting process at Connexa, we do typically underwrite for strategic M&A for either sponsor-backed or just standalone companies. Call it, Google, NVIDIA, name your flavor of software company that's related to the end market of our portfolio company. That's kind of what we play for. Just a lot of private equity sponsors are, very serial strategic add-on acquirers. And that's something that we do play for because that's where a lot of the value is created. Private equity these days, not just like the debt pay down arbitrage, but more of the arbitrage in EBITDA multiples where you have some dinky HVAC platform you bought for AX and AX EBITDA, and then you acquire all these smaller mom and pop shops for 3 times, and it just gets blended up to 8 times now because that's what the platform trades for. And that's something that we definitely see play for in terms of our exit underwriting.
And one thing I looked at when I was looking at your guys' website, you guys look at, for venture, it's also interesting to hear a venture fund looking at strong economic fundamentals, right? And as we mentioned before, I know, through our Sutton Capital private equity venture training program, we've had, we're fortunate to have one of our, alumni, join the Connexa team. And, one of the things I'm seeing here is, Connexa likes strong economic fundamentals. You don't always hear those words. You might hear it a little more with some of the New York-based funds, but I definitely don't ever hear that as much with, the SF-based focus funds, right? And looking at your background, your pedigree, and obviously some of the backgrounds of some of our alumni, it's interesting to see that you've got a team that's kind of coming in with some of that quantitative background. So we'll love to hear, kind of your thoughts on that in terms of kind of like how you guys like maybe some advice in general
Yep.
on, and I think the advice is going to be different for New York, college graduates that are trying to join a fund in, obviously in Manhattan versus SF, right? I mean, I think there's still a lot more quantitative metrics that New York based investors look for. They look at the financials versus like just the vibe. So, just advice, if you're joining maybe a New York based fund, how would you think through sourcing, screening? What are some of the financial metrics, especially in the early stage, that you look for? And how can people maybe build like an investment thesis when they're kind of approaching that?
Yeah. To have strong unit economics, that kind of goes in hand with the relative scale of the business, right? If you have no revenue, no products, there's no unit economics to report, right?
Mm-hmm.
So the businesses that we look at kind of have like a minimum threshold of like $1 million run rate. So 12 times last month's revenue, or just, annual revenue for that matter. So we're usually like striking in businesses that have like 1 to 3 million ARR, right? You can dissect that now by looking at revenue by customer. And revenue by customer tells you two things mostly, right? Logo retention and net dollar retention as well. So logo retention, that kind of plays into, product market fit. Are your customers staying, right, for, greater than whatever benchmark that you're looking at for the business? Is it transaction-based? Is it subscription-based? That does play a role in terms of how healthy this logo retention should look. And also the dollar expansion. Are customers retaining and also spending more on your platform over time, which is super important because that would play into another metric we look at is LTV to CAC. Are you acquiring businesses, are you acquiring logos or customers or individuals at a healthy CAC, the customer acquisition cost?
Yeah.
If LTV to CAC is underwater, ultimately, like, this is just not going to bode well for your business. You're essentially just going to be running improfitably forever. So you need to have strong CAC payback. You need to have good retention. We also are very adamant and keen on looking at businesses while they're at a growth inflection point. Something that's a little more fluffy in the asset class compared to like PE, or even sometimes growth equity too, is that, who's on the cap table sometimes matters in terms of, raising subsequent rounds, and hypey VCs like hypey businesses that are growing at a very fast clip, right? Or that are in a hot space. And it's important to kind of get in early a little bit with businesses that already have sound unit economics that are now going to be well capitalized beyond belief by funds that don't do the same level of diligence as us. And they're more just looking at the big picture where they like management, they like the space they're in, the product seems cool, we're in, right? And they'll upsize the check 10 times the amount that we're going in. Ultimately, we operate as a co-investor. So fortunately, I don't really do that much traditional LinkedIn cold outreach to folks. We have a strong LP network, co-investor and LP network, I would say, for that matter too, where we get proprietary deal flow from other funds that are either have a portfolio company that's looking to raise, have a company that is looking for a lead, or has, XYZ amount still left in the rounds. And we'll do our own due diligence to assess the company, outside of the vacuum of like who's around at the table for it, and call heads or tails of whether we want to do the deal or not. That's something I really appreciate about my work in venture as a more junior associate than I would say other folks that are hosting dinners with founders and, engineers. And it's just like, it's not classically real work, so to speak.
Yeah.
It's all just like networking, but that's the game they play, right? And so I gotta respect the hustle, but that's not something I want to do, and that's not something that Connexa does.
Yeah, no, I totally agree. I think one frame of mindset, maybe it's the Gen Z mindset. They, it's interesting. I saw this really interesting stat. So there was there was some statistics around some of the, the Twitter VCs, right? Like the Gen Z VCs that went out and raised their first fund. And, there was some data around like a lot of those managers not being able to raise again, like after their first fund. So sometimes those disciplined skill sets, if those are less of a focus than building the TikTok page and, kind of doing these dinners, and you're not actually, finding the deals that are actually going to, if you're not actually sourcing, picking and winning effectively, where you're going to potentially look at every deal that's going to return the fund, that might put you at a larger macro risk to, have potential to raise your next fund, I would say, right? But I don't know what your thoughts are around that.
Yeah, we're definitely not playing the power law where we're hoping that, 5% of our portfolio makes up, whatever percentage of returns of the fund. Every single deal that we underwrite to is like at a healthy exit, like net MOIC, right?
Yeah.
Of like, call it like 2 to 3 to 4 times, right? Versus the Ubers and, unicorns of the world where, some seed investors are just looking for a 50x for every deal.
Yeah.
Right? And you can play that game and you can be very successful at it, right? But I feel in terms of where our focus is that if we are just try to minimize as many zeros as possible and hope that most are at the 2 to 3 times MOIC, that is a very successful venture capital firm.
And there's just based on historical statistical data, it is just not realistic to like have 50 baggers and like all of your portfolio, right? I mean, there was some data. I mean, the emerging manager ecosystem, you're going to get a 5x cash on cash, mostly from like the emerging managers, right? Because just when you look at the magnitude of the funds, like the mega funds, you're not going to get that type of return because just proportionally, when you look at the size and like, how that size relates to the returns, just that ratio is going to be easier to achieve with a smaller fund. So I think that's kind of what you're saying too.
Yeah. If we're a first time fund, right, and we want to have longevity in this world, this fund one has to go well, right? One. And two, if we're, working alongside another GP who has like a $500 million venture fund, right? If they get a 2.5 like miss, right, and 2.5 million check goes to zero, and it's like, all right, whatever, rounding it, right? But if we're doing our $500K or $1 million check for a fund one, that's real money to us, right? All
absolutely.
Relative. And it's really just making sure the portfolio survives and that the level of due diligence that we do relative to peers is leagues ahead. Not to tap or talk down on any other firm, but that's just ultimately the way we operate. We hope to scale that in the future with either larger funds or just more diversified checks.
Yeah. And, I know we're at time. So last thing that I always ask everybody is just one piece of advice. It could be from a relative, it could be from a mentor, and it could be about just life as a whole or just kind of your investing career.
Yeah. Just be risk on. That's kind of one thing I've always learned, either on yourself, work that you're doing, right? Taking a chance. Any person that does well for themselves, right, more often than not, they took risk in their life and made something of it. You don't always have to be lucky, but if you're lucky and you take risks, very well. Not something that I live by.
Yeah. No, I totally agree. I mean, I think there's a utility of kind of taking that risk and thoughtfully doing it, but obviously like if you don't do it, it's a bigger risk to not get to the places where you want to be. And I totally agree with that. So thanks for that. Thanks for reinforcing that. Awesome. Well, hey, Troy, have a great week. And I was going to say thanks. We keep talking over each other, but thank you so much for all that you do. Give Jonathan a special thank you for me, and appreciate all that you guys do for the founder community and for just the community as a whole.
Awesome. Thanks, Joel. Nice chatting.
Yep. Absolutely. Take care. Bye.